Hey everybody, Hunter Satterfield, one of the partners here at Cain Watters, as well as the Chief Investment Officer. As always, I am joined by my fellow partner, Brian Bortz, who is the head of the Cain Watters Investment Committee, as well as Brad Sanders, the Managing Director of Tectonic Advisors. We'll be in front of you today to discuss March. As always, this is your March monthly update. For the month of March, the S&P 500 was down 5%, with global stocks down 7.3%. Domestic bonds down 1.8%, and then global bonds down 3.1%. So everything's down there, which we'll certainly get some color commentary from Brad on. It's important to note this is just for the month of March. And obviously, a lot of this has to do with geopolitical issues going on over in the Middle East, specifically in Iran. And Brad, I think that's the best place to start. Let's just focus first on equities. So, really tough month for basically every index that's out there. Still year to date, while the S&P is down, still year to date, a diversified portfolio is actually up for the year. That being said, you want to talk a little bit about the equity markets, sort of surrounding the geopolitical tensions we're dealing with?
Yeah, I think initially the Iran war kicked off right after month end, so we dealt with it the entire month of March. The first couple weeks were more fear that you normally see when you see an escalation in the Middle East and you see war kick off. So you just had a risk off. And then the back half of the month, super volatile. And what's happening now that everybody's kind of getting a handle on what's going on is you have the Straits of Hormuz closed, and you have oil up 85% year to date. When I walked in here, Brent crude's somewhere 105 to 107, depending on the minute. And equities are just going to stay volatile in that kind of an environment because oil feeds into every income statement and every balance sheet of every corporation in America. It's the number one input cost for anything. Everybody's got to keep the lights on. If you manufacture something, it goes into that. If you eat, you have to power the machines to do all that stuff. So it's an inflation push, it's a cost push, and it's going to make future cash flows harder to figure out. And so you're going to see companies bouncing around. And now we just have to deal with how long is the duration of this? When's the resolution come? How long does oil stay elevated? Is it going to be a blip or is it going to be a longer term adjustment? That's what the market's trying to figure out. All in all, our portfolios have done really well weathering it, very diversified. This isn't a market you can hedge. I was talking with Brian when we walked in here. This is something can be tweeted. The market was down 2% this morning, then it was up 50 bips, and it was down 45 bips when I walked in here, and that's in the first 3 hours of trading. So this isn't something you can get cute with. You have to just stay diversified, stay the course. This too shall pass, but expect a very volatile environment. I will say the VIX has been over 30. That's the volatility index. It's off the CBOE where you measure options hedging. It's a good way to measure volatility in the market. It's over 30. Generally, the last 5-6 times it's gone over 30. It dissipates relatively quickly. It doesn't stay that high that long. So I think we've probably seen peak volatility, but I would expect it to be a very volatile environment as we go forward over the next couple months.
Yeah, and I think that volatility, Brian, you've talked about on the last couple recordings, that we are seeing more vol in particular. That being said, over the last year, the S&P is still up 12, 13% over the past year. This is really like a sort of a hyper-focused issue right now surrounding these geopolitical tensions, maybe some Fed interest rate policy, things like that. Sure. What do clients do when it comes to portfolios in these moments of time?
I can tell you, Hunter, what they don't do, and I want to look dead in the camera when I say this and give everyone that's listening to this kudos. I really honestly haven't had the client phone call saying, hey, what do we do? This has been a tremendously volatile month, but I think when everyone looks at the portfolios that we've put together, especially the diversified portfolios we talk about, we're still in the green. We're still positive, which goes to show that we do build these things to protect downside volatility, and that's actually happening right now. So most of our clients are very aware of what's going on. I don't think that there's too much of a sentiment out there in our client base that this is a prolonged problem. I think it's, to your words, a very hyper-focused, it's going to happen and we're going to get through it. If you look at where the portfolio was for the beginning of the year through the end of February, the portfolios, the market, the economy, everything was crazy strong. And there's no reason to think that once this blip that happens in the Middle East is over, that we won't go back to that type of economy. So I think our clients are weathering this incredibly well, and kudos to you guys.
Yeah, Q1 so far already we're through that, and we've got obviously 3 more quarters ahead of us. And normally, you know, this would probably be where we would cut off. But for those that want to hang on very quickly, I'd love to come to you, Brad, on now that we're through Q1. Talk a little bit about fixed income. So it's a tougher month for fixed income in March, but largely this year it's been sort of a smooth, steady year. Talk a little bit about what's going on in the fixed income markets year to date, and then maybe what caused some of this fall in March.
Yeah, I think the fixed income markets had priced a couple rate cuts in the back half of this year. And so you have, you know, the front end pegged at 375, and everybody's thinking we're going to get down to that 3.25 if everything goes awesome, 3% by the end of the year. And now you have this thing with Iran, and you have oil where it is. That is going to cause inflation. There's no way around it. Whether it's temporary or permanent is the argument, or some kind of permanence where it's going to be higher than normal. Once that happened, the bond market's kind of in a tizzy because it can't decide, are we still going to get rate cuts? You know, Warsh is going to get confirmed in May. He may not have the ability to cut if we have 3 to 4% inflation because of this oil problem. And if it stays and we don't get a resolution over the next couple of weeks, it's going to keep pushing those rate cuts out. So that's why you saw the 10-year prior to the war had dipped below 4%, and then we were starting to price in, hey, we're going to get these rate cuts, inflation's in check, and now you have a curveball. And so the bond market will figure this out. Everything's just in flux and it's headline driven. Once we kind of get some sort of directionality, the bond market will settle down. I still think, you know, with entry yields where they are, it's a good part of your portfolio to own. It does the heavy lifting for you diversification wise. But in a month where you take the world's largest commodity and you spike it 85% year to date, you're going to have inflation concerns, and that's just where we are.
Yeah. So lots, folks, ahead as we look at the next 3 quarters for 2026. We'll be back in front of you at the end of March. Hope you have a wonderful April.